Hey everyone, Matt Brunig here. I got this comment recently on one of my other videos. Fuzzy Hobbit Feet says, "Great vid, this is super topical, but could you do a vid talking about the ridiculous proposed replacement of the income tax with a 30% sales tax?" I've actually had a number of people ask me to do this lately. They're referring to a proposal that's often called the fair tax, capital FAIR, and it is one of the bills that the kind of Freedom Caucus, sort of like dissident group of Republicans, really insisted on pushing as part of agreeing to have Kevin McCarthy be the Speaker of the House, all this sort of procedural minutia. But that's why it's kind of come to prominence, because it seems like we're going to get a vote on it soon. I don't think that most Republicans actually support this thing, but enough of them do that it's going to become a thing, and so I figured let's jump into it. It's also a really funny topic because it's crazy. The idea is crazy. Even the story of where it came from is kind of crazy. So hopefully you'll find some interest in it, even if you're not interested in tax policy per se. So let's start from the beginning, of course, which is where the hell did this fair tax proposal come from? And the answer, believe it or not, is it comes from Scientology. So this is a piece from 2007, published initially in the New Republic, but here published on CBS News. The author is Bruce Bartlett. Bruce Bartlett is a longtime conservative tax expert. He used to work at the Cato Institute. He worked for the Reagan administration. These days, he's more liberal, I guess you would say. But he's got some interesting stories from back in the day. So he wrote this piece called Scientology's Fair Tax Plot. And he recounts the story of where it came from. So the story of fair tax's provenance is one that I can tell with some firsthand knowledge, Bruce writes. In 1993, fresh from a stint at the Treasury Department, I spent a few months at the Cato Institute, which is a libertarian think tank. I was filling in for Steve Moore, now an editorial writer at the Wall Street Journal, who took a brief leave from his job as director of the think tank's fiscal studies program, blah, 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 blah. It was there that I was visited by a man named Stephen L. Hayes, the founder of a group called Citizens for an Alternative Tax System, or CATS, that promoted the NRST. The NRST is National Retail Sales Tax, and who was, as Moore pointed out to me, a prominent Scientologist. It wasn't hard to figure out the Scientologist motives for hawking the NRST, also known now as the fair tax. The IRS had refused to recognize Scientology as a legitimate church, a fact that seemed to enshrine their popular reputation as a cult. To remedy this situation, Scientologists waged war against the IRS. At various points, the church attempted to infiltrate the tax authority and even hired private investigators to examine the private life of IRS officials. And the same impulse behind these measures led them to devise the NRST. One church spokesperson told the National Journal's Paul Starobin, "We thought, if this discrimination is happening to us, there must be a lot of people to whom this is happening. How could some positive change be made? Since nearly every state has a sales tax, it would be a simple matter to get them to collect a federal NRST, rendering the IRS instantly superfluous, a ripe target for abolition." Anyways, the long story short of this is Scientologists push this because their battle with the IRS to be considered a tax-exempt church. Then it filtered into right-wing politics. Eventually, there was an organization called Americans for Fair Taxation that picked up the plan and started proposing it in a way that was divorced from its Scientological origins. The Scientologists themselves, they eventually were recognized as a religion by the IRS, and so they'd kind of lost interest in the whole thing. So we basically have this weird Scientology proposal based on them trying to avoid taxation that's sort of become this zombie idea that they successfully kind of infiltrated the right wing with, but now the right wing just like has picked it up on itself, at least certain kind of nutty fringes of the right wing. So that's what we're dealing with. So what is the fair tax or the national retail sales tax? For starters, before we get into some of the numerical details, let's talk about sort of prong one of the big selling points, the thing the Scientologists really like, and the thing that seems to chum up the right-wing base. The first thing they'll tell you about the fair tax is when we switch to a national retail sales tax and get rid of the federal income tax, the payroll tax, all that kind of stuff, we will abolish the IRS. Now, when you first hear this, you have to ask yourselves a question. Well, wait a minute, you still have a federal tax. So who's going to collect the federal tax? How do you abolish? Like, there's still tax collection. It's a different tax, but it's still tax collection. So surely there's going to need to be some kind of federal tax authority, right? And the first thing they'll tell you when you say that is they'll say, oh, no. We'll have the states collect the tax. And so we see here, this is from bill text from the last time this was introduced in Congress. This is chapter 4 of the bill. And, it says federal and state cooperative tax administration, blah, blah, blah. The tax imposed by Section 101, which we'll go over in a minute, within a state can be collected by a state if the state is an administering state. An administering state is a state that maintains a sales tax and enters into a cooperative agreement with the Secretary of the Treasury saying that they're going to collect this tax, right? So they don't require states to collect this tax on behalf of the federal government. They simply say states could collect it on behalf of the federal government, and the states and the federal government will pay the states a little bit of money to do this. Now, they cannot require states to collect this tax, constitutionally speaking, and many states will not collect the tax. So what do you do then if a state doesn't collect the tax? Oh, no problem. We'll just have the federal government collect the tax. The Secretary of the Treasury shall administer the tax imposed by this subtitle in any jurisdiction that is not an administering state or elected to have another state administer, right? So the federal government is still going to be collecting taxes. Now you might say, oh, well, wait a minute. So this thing where we say we're going to abolish the IRS and have the states collect the tax, yet you have federal administration of taxes. So how do you abolish the IRS? It seems like the IRS is going to be responsible for administering the tax in states that don't cooperate and run it for you. Oh, you may think that, but you're very mistaken. Because at the end of the statute here, we get the establishment of 2 new tax agencies. There shall be in the Department of Treasury an excise tax bureau, because they're still going to have federal excise taxes. They're not getting rid of those. That used to be done by the IRS. And then there shall be in the Department of Treasury a sales tax bureau. Abolish the IRS. Abolish the IRS, asterisk, create 2 new tax agencies inside the Treasury. Already off to a bad foot. Already off to, like, I don't know, one of your main gimmicks seems like it's not quite accurate, and maybe you're kind of using it to chum the waters for dum-dums. All right, so that's abolish the IRS. Next thing we have here is what is the tax? Okay, so we're gonna clear out a bunch of federal taxes and create a new tax. So what does this new tax look like? Here we go here. There is hereby imposed a tax on the use or consumption in the United States of taxable property or services. In the calendar year 2023, the rate of the tax is 23% of the gross payments for taxable property or service. Now, here's another bit of deception here. They say 23% of the gross payments. Now, you would look at that and you would say, oh, it's a 23% sales tax. And most people live in states that have sales taxes. You know what that looks like on the bill. There's a little line. Oh, it'll just say 23% there. Wrong. 23% is 23% of the gross payments. So what they do is, the best example of this is to take $100, right? So I'm going to put this up in the bar here because you can do a little math up here. Okay, so we take $100. And what they're actually going to do is they're going to impose a 30% tax on that $100. So it's actually going to be $130, right? The bill will say $100 for services or goods and then $30 for tax. But then they take the 30 and they divide it by the 100 plus 30 and get 23%. You see what I'm saying? So the 23% is actually the amount of tax that you're paying divided by the price of the good plus the tax that you're paying. Like that's in the denominator, right? The price of the good plus the tax that you're paying, and they just divide divide the tax into that. So anyways, it's not a 23% tax, it's a 30% tax on goods and services. But it's actually not even a 30% tax on goods and services, because you notice this is for the calendar year 2023, right? What happens after 2023? After 2023, you wind up with this other system. So only for 1 year is it this 30% tax that they call a 23% tax. It's only for 1 year. That's what they'll put in all their stuff. 23% sales tax, 23% sales tax. It's actually 30%, and that's actually only for 1 year, okay? The next year, you basically have three taxes, I guess, if you will. You can see them right here. The general revenue rate, this is the Social Security tax, and this is the Medicare tax, right? So we have the general sales tax, I guess, if you will. That's going to cover general revenue. We have the Social Security tax, and then we have the Medicare tax. All that's going to be in the sales tax. The Social Security tax we have now and the Medicare tax we have now, those are all going away. So we're going to have a tax, one sales tax that contains these three rates. Now, the top rate, they're actually setting it at 14.91. Now, remember, it's 14.91 divided by 114.91. It's actually, wait, excuse me. No, it's the reverse. Anyways, it's higher than 14.91. That's just the number they're putting in there to be deceptive. So, but what is this then? They don't give a percentage for this. If you go, finally, you find it way down in the text, and you see here what these two rates are going to be. So the Social Security tax, they're going to get rid of it. And instead, they're going to tell the Social Security Administration every year, I want you to figure out a sales tax rate which will be necessary to raise the same amount of revenue that would have been raised by imposing a 12.4% tax on the Social Security wage base, right? So right now, the Social Security tax is 12.4% of all personal earnings below like $120,000 or something like that. So they're telling the Social Security Administration for every year going forward, I want you to figure out how much you would have raised if we had just kept the old Social Security tax. And then I want you to figure out what kind of sales tax we would need in order to raise that same amount of money. And then they're going to do the same thing for the Medicare tax, except for the Medicare tax, they're only doing the 2.9% tax, but the Medicare tax actually goes up to 3.8% if your income's over 200 grand. So they're missing some of the Medicare tax in here. I think that was probably an oversight because most people don't realize that actually the Medicare tax does go up to 3.8% for income over 200 grand. You know, hey, not the worst error, I guess, in this piece. But yeah, so these taxes are actually going to like change every year, and we don't even know what they are. They just basically tell the Social Security Administration to figure it out. But now you have to ask yourself, how is the Social Security Administration even going to figure this out? Right? Because if you're telling them, hey, I want you to figure out what you would have raised if you used the old 12.4% tax on wages. But as we get further and further from this reform being enacted, they're not going to have like data to do that unless you're going to allow them to continue to collect all, you know what I'm saying? Like the information's probably not even going to be present to do it. But yeah, whatever. So 30% in year one, who fucking knows in year 2, 3, 4, 5, 6? We don't know because it just depends on what the Medicare tax and Social Security, whatever they come up with. Now, it's worse than that, though, because they say 23%. It's actually 30%, but it's actually 30% for 1 year because for other subsequent years, it depends on what the Social Security Administration decides to set their tax at. But they claim this is going to be able to cover all of the revenue that we need, right? We'll be able to replace the income tax, the payroll tax, and all that. We'll be able to replace it with this tax. But that then raises the question, will you? What are the odds that this 30% rate, which by the way, they've been floating for decades, it's going to hit exactly the revenue we have now? What a lovely coincidence that would be, that has just been the consistent amount of revenue we've needed for all these decades, and that you could replace all, even as the other taxes have gone up and down, it's always been we need exactly at the 23%, which is really 30% national sales tax. So there was an effort made in 2004 to actually figure out, is this right? Can you actually raise the amount of revenue we need and implement this proposal with a 30% tax rate, which again, they're calling a 23% tax rate? And the answer is no. So we have this from the Brookings Institute, and they did some pretty simple back of the envelope math. And they determined that to replace all federal taxes on a revenue neutral basis over the next 10 years would require a sales tax rate of about 60%. Not 30%, 60%. And I'm not sure if this is defined in the goofy way that they do their math or in the real way that normal people do the math, but it's 60. It's at least double. Now, this 60%, I'll say I have some quibbles with the way Brookings did this, because one of the things they do is they assume 20% of the tax base for this kind of tax would be eroded due to avoidance, evasion, or legislative action. I think, and I'll get into this in a minute, clearly there would be a lot of avoidance and evasion, and that would be a problem. But let's just give them the benefit of the doubt and put that 20% back in. If we put that 20% back in, the rate still goes to 48%. So it's not 23%, it's actually 30%, but actually that's more like 48%. And that's if you get perfect compliance, which you're probably not going to get. So who knows, 50% or maybe even 60%. That's what we're really talking about here. Now, what does this all amount to, in terms of not just what is their tax, but also what are the taxes that they're supposed to replace, right? Because, maybe it's a good deal on net. We shouldn't just look at one tax in isolation. We should look at the whole proposal. And so I do that here with this spreadsheet. So these are the big taxes, that there are other little bullshit that they knock out as well, but this is the big stuff that they're going to replace, okay? So we have the federal income tax, which if you're familiar, has this marginal rate structure that goes from 0% to 37%. Here, I think is a good little depiction of this. Well, I guess we should start here with the deduction. So under the federal income tax, if you're a single person, the first $13,850 you earn is completely untaxed. You don't pay anything on it. So if you make that or less, you're just completely in the clear. If you're married, you double that to $27,700, right? So that's essentially the zero rate, right? If you earn less than that, you don't pay anything because your standard deduction just wipes out your taxable income. From there, for every dollar you earn beyond those thresholds, if you're a single filer, you'll pay 10% for the first 11,000 of earnings. If you're a single filer, 10% for the first 22,000. If you're a married filer, 12%, 22%, 24%, and so on and so forth. Heads of households are single parents, roughly speaking. So we have this progressive income tax where if you make very little money, you don't pay any tax at all. And then if and then the amount you pay escalates the more you earn. Then we also have the Medicare tax. As I discussed before, the Medicare tax is a 2.9% tax on all personal earnings. So we're not doing singles versus married. There's no zero rate. So personal earnings, you pay 2.9% of all of your earnings to the Medicare agencies, Social Security Administration, and then they use it to help finance Medicare. If you make over $200,000 a year personally, not in a family, but personally earn over $200,000 a year, your Medicare tax rate will go up from 2.9% to 3.8% for the amount that you earn beyond the $200,000. The Social Security tax, it's 12.4% tax. Unlike the Medicare tax, the Social Security tax, which we see here, I was way off. The Social Security tax has a limit. So you basically pay 12.4% of your earnings up to $160,000 of earnings. And then every dollar you make beyond that, you don't pay any Social Security tax on it at all. Then we have the estate tax. The estate tax is basically paid when you die if you have a unbelievable amount of money, and you also were too stupid or too honest to use estate planning to shelter it from tax, which is to say very few people, you will pay anywhere from a marginal rate anywhere from 0 to 40%, but again, only on the amount beyond these thresholds. So let's look at it in 2023. I think this is for a single person. Yes. So in 2023, your estate, when you die, you have to have $12.9 million in your estate. Needless to say, very few people have that much. And I think for married couples, you actually double this to over $25 million. So if you have that much money in your estate when you die that you're passing on to heirs, you will pay 0 to 40% of the amount in your estate that exceeds this threshold. So the first 13 million is tax-free, and then you only pay beyond that. So that's a very high-end tax. Corporate taxes on profits, 21%. Capital gains tax, so if you buy something and then you sell it for more later, like a stock or a bond or whatever, you will pay anywhere from 0 to 20% for long-term capital gains. So they're going to replace all of this with this national retail sales tax, which, as I said before, is under their proposal 30% for the first year, but at least really 48% to be revenue neutral, maybe more like 50 or 60% when you include all the other stuff. But I'm going to stick with 30% because that's what they say, and you can fill in the blanks if you want on that. Okay. So what happens when we replace all of this with this? The best way to get a look at this is using the what the fuck is this called? The Consumer Expenditure Survey. Shit. The CEX. Oh no. There we go. The CEX, the Consumer the Consumer Expenditure Survey. Okay. So once a year they put out this survey. The Bureau of Labor Statistics does, where they basically break people up into 5 groups. You can also get them broken up into 10 groups, but 5 is a little easier for our purposes here. And they say, okay, how much did the bottom 20% of consumer units, families, roughly speaking, what was their income, and how much did they spend on food, vehicles, whatever? Right here are all the categories of spending: food at home, cereals, beef, like it's all broken down. So you can see kind of on average, how much do people actually spend each year on stuff, okay? And so I have brought this all together here just to kind of make it easier for you. So if we take quintiles, remember, are 1/5 of the population. Quin is like a 5 or whatever. So the first quintile is the poorest 20%, the poorest fifth. The 5th quintile is the richest 20%, the richest 5th, and then we've got, these 3 in the middle. So I've highlighted the bottom 2 quintiles, which is going to be the bottom 40%. And let's look at their pre-tax income. And I do that because these taxes are for the most part applied to income. Now the corporate tax, obviously, that's paid by corporations. You could model it as being paid by shareholders. The bottom 2 quintiles are not going to have much liability from these. These are really like rich people asset taxes. And then these are the taxes that regular people pay. And those are based on income. And notice those are either based as a percentage of income, like a flat percentage of income, like 12.4%, or they go up with the more income you make. With Medicare, it only goes up a little bit from 2.9% to 3.8%. But for the federal income tax, it goes from paying 0% to 37%. So it scales with income. So the distribution of income will give you at least some sense of how much tax each person is paying. As you can see, the bottom 5th only has about 3% of pre-tax income. The top 5th has 52% of pre-tax income. So if you were to do like a flat tax on income, the bottom 5th would pay 3% of all taxes, and the top 5th would pay 52% of all taxes. But of course, as noted already, we don't have a flat tax on income. The taxes go up with the more income you make, at least for those specific taxes on the federal level. So if you were to try to give you some sense of that, it would be even more skewed towards the top than 52%. So this is on the lower end. The other thing to note here is that when we're talking about the federal income tax in particular, this one, the federal income tax consists of these tax rates, but it also consists of these what are called tax expenditures, essentially welfare programs that are implemented through the tax code. The most prominent ones that are going to be of some use to these two quintiles is going to be the earned income tax credit and the child tax credit. So the earned income tax credit and the child tax credit completely wipe out. Well, let me take a step back. The standard deduction completely wipes out, or almost entirely wipes out, any tax liability these two quintiles have, right? Remember I said the first $13,000 or whatever that you earn is untaxed entirely, and then for married couples it's double that. So that's going to completely wipe out their tax liability. But then these people will also often be eligible for the earned income tax credit and the child tax credit, so they actually get money back. They don't pay anything. They are net recipients from the tax code, which seems very strange, but that's how it's set up. Now, the fair tax is going to get rid of all that. It's not just going to not tax you anymore based on income. It's also going to get rid of the earned income tax credit, the child tax credit, and other smaller credit programs that actually provide some income to these people. Okay? Anyways, that's pre-tax income. Now let's go to expenditures, because that's what the fair tax, the national retail sales tax, that's what it would be applied to, would be how much are you buying. And as you can see, the distribution of expenditures is quite a bit different than the distribution of pre-tax income, right? So instead of 3% of pre-tax, so for pre-tax income, the bottom quintile has 3% of it. For expenditures, it has 9% of it, right? And what's going on here? How do you spend more than you make? You might have savings. You might have to use credit. You also might be using benefits like food stamps and stuff like that, right? So triples. And then at the top, the share of pre-tax income is 52%, and the share of expenditures is 38%. As you can see, the top is not spending, the top only spends $128,000 of their $226,000 of income. You see what I'm saying? So they're saving. And of course, if you have a lot of money, you're going to save money, right? And so if you're saving, you're not, you're not having to pay any tax on the amount that you're saving, because you only pay tax on the amount that you spend. Anyways, here's the payoff here. Let's take the 30% expenditure tax, the national retail sales tax, and we'll just multiply expenditures by that, okay? And so we get how much the national retail sales tax, roughly speaking, would be for these 5 groups on average. And then we can divide that as a percent of income. So 70% of income. For the bottom fifth, this goes up to 70% of income. That seems high to me. Personally. Now, I'm not against all consumption taxes. Some people are really against them. I think consumption taxes are good. I love all taxes. I'm a tax positivity man. But replacing taxes that are based on income and that are progressive and hit the top much more than they hit the bottom with these taxes, with a national retail sales tax, and getting this outcome is clearly a bad idea. I think clearly a dumb idea. Okay. So let's finish out here. There's another element of the fair tax. Oh, Matt, you're just talking about the tax part. What about the prebate? What about the prebate? You may have heard this. So in addition to taxing everything you buy by 30%, which actually will probably be higher than that, the way they try to kind of sell this, because if you point this out, you go, look, that's really hitting the poor real bad. They go, oh, no problem. We're going to give each person in the country a family consumption allowance. Sometimes they call it a rebate. Sometimes they call it a prebate. And this is kind of an interesting setup, okay, because it's basically a universal basic income that they're going to give to every family. And they're pitching it as this is a refund for your sales tax. But here's the interesting thing about it, okay? Because that's how they pitch it, and that's not even actually true. It's not even enough to refund the sales tax. Anyways, let's look at the amount of this family consumption allowance. Each qualified family shall be eligible to receive a sales tax rebate each month. The sales tax rebate shall be in an amount equal to the product of the rate of tax imposed by Section 101 and the monthly poverty level. Now, the rate of tax imposed by Section 101, we just went over that. in Section 101, it's described as 23%. It is actually 30%, but it is described as 23%. So for this, put 23% in, right? So each family is going to get 23% of the monthly poverty level refunded to them, right? Essentially a basic income, okay? But the tax that they're paying, remember, is actually 30%. So even within the logic of the bill itself, you should be giving them at least 30% of the monthly poverty level, right? The idea here is like, look, if you spend the poverty line worth of stuff, we don't want to tax the first poverty line worth of stuff that you spend. If you are just buying a poverty level amount of stuff, we don't want you to pay the consumption tax. But the poverty, if you were buying the poverty level of stuff, you would be paying 30% times the poverty level. But then the rebate is actually only 23% times the poverty level. So there's a 7 percentage point difference there that within their own logic, they should be rebating, but they're not. Anyways, what does this look like in practice? You could see for family sizes and stuff here. I just use the poverty guidelines from HHS. This is what's typically used for programs that base things off the federal poverty line. They usually use this one. Anyways, so per person, if you're a one-person family, you would get $279 a month. If you're a two-person family, $189, $150, right? It kind of descends from there. This would not be enough to deal with this, right? I mean, even this is the annual amount. So let's see what the annual amount is. I probably should have, so this would be the annual amount that you would get. Annual prebate. This would be the annual amount you would get, but this is the annual tax that you're paying. See? So their net tax is going up on the bottom by quite a bit. If you're like you see, even the 5-person family who's getting a lot of prebate is still less than the tax. And right now, remember, they're not paying any tax. And in fact, they're getting money back from the tax system that the fair tax would eliminate, right? So they're like clear losers, like big time losers from this change. All right, the last thing I want to talk about with this is the idea of a sales tax generally. Now, I have a slight story here. Well, it's not an interesting story, but I've known about the fair tax for a long time. Of course, I've been interested in heterodox politics of all sorts. And when I lived in D.C., I used to live across from the hotel where they would have these like libertarian conferences every year. And I would just go to libertarian conferences. I wouldn't pay or anything. I would just go in and I was always curious, like, would they kick me out or what would they think about me roaming around? And one year, I did start rigging their straw poll for president because they had this internal link that they were sharing to conference attendees. And if you were there, you would go in and they'd give you this piece of paper and had this like little internal link. And they didn't really have any security about who could, like, you didn't have to set up an account or anything. I think the idea was just, well, look, this is this link that only people in the conference know about. We set up this kind of like hidden little website. And so people will just go in and vote for it. Of course, the second I get it, I go, okay, I share it on Twitter. And I say, everyone go in here and vote for Donald Trump. And immediately Donald Trump was dominating the polls for the Libertarian Conference preference for president. This was during the primaries in 2016. That was a fun thing. They still didn't kick me out, though. They did start tweeting at me and say things like, Matt, you're not included in our Salesforce database as someone who paid. What are you doing? But I don't know. No one like chased me down. I don't know that they even knew where I was. This is a giant conference. It would have maybe been difficult to find me. But yeah, that was fun. But they always have these booths set up, and the fair tax people are always there. And they're always pushing this crazy-ass idea. No longer Scientologists, of course, but now all sorts of right-wing weirdos. And I went over to them and I was like, why do you do a sales tax when you could do a value-added tax? Because other countries use consumption taxes, but they use value-added taxes. They don't use sales taxes. And like a value-added tax just seems to be a lot better. And they didn't have a good answer. Now, I think this is perhaps unfair because the random volunteers they found for this table maybe were not prepared for detailed questions. But here's why I asked that question, because the problem with the sales tax is that it's really easy to avoid. It's really easy to evade. It's very, there's a lot of ways to cheat a sales tax. And this is why in other countries, when they do consumption taxes, they use what's called a VAT, or a value added tax. So in this spreadsheet, I just want to explain the difference between these two things, because it's important for understanding, optimal consumption tax. But so in the first example here, we've got the way a VAT would work, okay? And I just kind of put up this sort of like bullshit kind of supply chain example, right? So imagine you have a corn, and let's say the supply chain for corn starts with the corn grower. This is simplified because obviously the grower buys tools from other people and all this kind of stuff. But for our purposes, let's just imagine that the corn, from farm to table, this is how corn gets into your belly. It starts with the grower, okay? And the grower, we're going to say he harvests corn, $100 worth of corn. I don't know how much that is, but let's say he harvests $100 worth of coin. Now, if you have a value-added tax system, of course, they didn't buy the corn from anyone else, so they don't pay any VAT. When they sell the corn to the processor, they are going to collect the VAT. Here, the VAT is 30% because that's the same tax rate that is in the fair tax, right? So they'll collect that from the buyer. In this case, the buyer is the processor, right? So when the grower sells it to the processor, he'll say, hey, I have $100 of corn. In addition to that $100, I need you to pay the $30 of VAT. And then when the grower gets that $30 from the processor, he'll give that $30 to the state and pay it as tax, right? Okay, great. Next up, the processor. Now, the processor has the corn. They bring it into their factory. They put it into cans, okay? And then they go and sell the canned corn, let's say for $150. They sell it off to a retailer. Now, when they sell that to the retailer, they're going to collect $45 of VAT from the retailer, because 45 is 30% of 150. So they're going to collect $45. Now remember, they already paid $30 to the grower, okay? When they go and sell it, they're going to collect $45 from the retailer. Then from there, what they're going to do is they're going to take the $45 they collected from the retailer and subtract it from the $30 that the processor paid the grower, right? So you'll take 45 minus 30 and you'll get 15. That's the amount they're actually going to pay the state. So you see, for any given link in the supply chain, they will pay a VAT to all of their suppliers, and they will charge a VAT to all of their customers, and then they will pay the difference between them. They will take the amount of VAT that they collect from their customers, and they will subtract from it the amount of VAT that they paid to their suppliers. And the difference between them is how much they're going to be paying the state. And that's also the value added. That also tracks the value added of the company, right? Because we would say he bought $100 of corn, and then he added $50 of value to it by canning it. And so what's 50 times, what's 30% of 50? 15. So that's why it's called the value added tax. And then when we go to the retailer, we get the same thing. Remember, the retailer already paid $45 to the processor. When the retailer sells it to the customer, we're going to say that they sell it for $250, all these cans. They're going to collect 250 times 30%, which is $75. They're going to take the difference between these, and they're going to pay that off to the tax authority. Now notice when we get to the consumer pays the full $75. They don't collect any VAT or pay any tax to the state. They pay the $75 to the retailer. So at the end of the day, it is the consumer that pays the entire $75 tax, 75 being 30% of 250. It is the consumer that pays the full tax, but the tax is collected at every level in the supply chain. This differs from the sales tax, where nobody is paying any tax at any point until the very last transaction where the customer will pay a $75 sales tax to the retailer, and then the retailer will give it to the state. Now, you might look at this and say, well, look, at the end of the day, isn't it all the same? $75 goes from the consumer and makes its way to the state. And yes, in the spreadsheet, it's ultimately the same. In reality, what you're going to have is you're going to have a lot of retailers, especially, mom and pop, illegitimate kind of, they're going to find ways to cheat on this tax, right? Because when they bought the good, they haven't paid the tax yet, right? And there's no way to really know in some kind of final sense, where is the final consumer in all of this, right? Someone could pretend to be a retailer, pretend to be, oh, I know I have a little shop, and then buy the stuff that they need for themselves to live on, and then just consume it. And then they don't ever pay any tax because they're buying it sort of wholesale, right? So how do you know? You don't know, like, at the end of the day, whether whether the person who's buying it from you is the end consumer or not. And even if they're not the end consumer, it's also very easy for them to be like, hey, you know how I could beat my competitors? What if I just don't charge this tax? What if I sell it under the table? Right? With the VAT, you're not going to have that problem so much because people are paying tax up and down the entire supply chain, and it's being reported at every point in the supply chain, right? So like when the processor sells to the retailer, he is reporting to the government, hey, I sold $150 of canned corn to this retailer. They gave me $45 of tax. And then, of course, I already paid the $30 up to the grower, and so I'm only paying $15. He keeps track of all this because he only wants to pay the amount of tax that he's supposed to be taking. So everyone is kind of being double-checked up and down the supply chain. Their taxes are being double-checked and being double-reported, and so it becomes very easy to find someone who's cheating on the tax. With the sales tax, it's very difficult to find someone who really wants to cheat on the tax. And so you would want to do a VAT. And why they don't do a VAT, I couldn't really tell you. Again, like many things, these things kind of get going and take on a life of their own. Whatever Scientologists sort of kicked it off to begin with, it seems like their logic was, well, states already have sales taxes, and what I'm really trying to do is blow up the IRS. And so the best way to do that is to say, what if we blew up the IRS and had states collect all this tax? But of course, as mentioned already, states aren't the only entity that'll be collecting this tax. You would still need a federal tax authority, which, whether you call it the IRS or not, is the IRS. But putting all that aside, that seems like to be a kernel of where this comes from, and then people just copy and paste, and no one ever goes, wait a minute, why don't we do a VAT? The other explanation is they want tax cheating. They want tax cheating. And I mean, that's consistent with a lot of conservative politics. They're very not keen on enforcing tax laws, not just like cutting taxes, but also just like letting people cheat, especially rich people cheat, and just not making any effort to stop that. So there you have it. That's the fair tax, a highly regressive tax that's comes from some kind of Scientological background. And they claim to abolish the IRS. They don't really. It should be a VAT. The amount that they say they're going to tax is actually much lower than the amount that they actually are going to tax, and much lower than the amount that they actually would need to tax. But also, the tax rates are unknowable in the future because they just let the Social Security Administration set whatever tax it wants into perpetuity. Yeah, a mess, a fucking mess, like just a disaster, just pointless garbage of an idea. And then, it's not going to pass, but it's fun and interesting perhaps to walk through, and maybe you learned other things. Maybe you didn't know how that worked before. Could you imagine going the rest of your life without understanding how VAT is collected up and down the supply chain? Now you know. And we have the fair tax to thank for that. So send me more questions. I like answering questions. That's, easy, fun content for me. So I hope to get some more.